You know that feeling, right? You see a hot new company go public, its stock price just skyrockets on day one, and you think, man, I missed the boat on that one. Well, you are definitely not alone. There's this whole other world of investing, one that happens way before a company ever rings that opening bell. It's a world of huge risks and, just maybe, absolutely life-changing rewards. So let's pull back the curtain on this hidden world of pre-IPO investing.
And this right here, this is the quote that gives every investor a serious case of FOMO. It's this nagging feeling that by the time a really exciting company is available for you to buy, the party's kind of over. You know, that the real money has already been made by a handful of insiders. But how true is that really? And more importantly, is there any way for regular people to get a slice of that pie before it's all gone?
Okay, so let's start with the part we're all familiar with. The initial public offering, the IPO. Think of it like a company's big debutante ball. It's their grand entrance onto the public stage. But here's the thing. Turns out getting an invitation to that party is almost impossible. The best seats, they're always reserved.
Now, check out this number, 115%. What does that mean? Well, this was the insane first-day pop for Airbnb's IPO. A select group of big-shot institutional investors got to buy shares at the IPO price of $68. But the second it opened for public trading, the second you could buy it, the price was already $146. That's an instant 115% gain for the insiders before you could even click buy. You're basically starting the race a full lap behind.
So why does that even happen? It's because of this behind-the-scenes process called book building, which is really just a fancy way of saying there's an exclusive pre-sale. The big investment banks, they go to their biggest clients. We're talking hedge funds, pension funds, and they offer them first dibs on all the shares. It is a totally closed-door affair, and the average person is pretty much left outside, just waiting for the doors to open.
And you know, it's this exact frustration with the IPO system that makes investors start looking for a back door. They start asking, okay, how do I get on the real guest list? How can I invest before the IPO even happens? And that question leads them right into the private market, the place where venture capital legends are made and where those mind-blowing lottery ticket-style returns are actually possible.
And this slide just lays it out perfectly. The scale is completely different. I mean, on the public stock market, if you find a stock that goes up 50 or 100 times your money, that's the win of a lifetime. You tell your grandkids about that. But in the private world, investors are hunting for returns that are literally an order of magnitude higher. I mean, just think about Uber. The very first investors who got in when it was just a tiny startup, they saw returns in that 1,000 to 10,000x range. It's a type of wealth creation that's basically impossible on the public markets, and that is the allure. In fact, companies that pull this off are so incredibly rare that they get this mythical nickname, unicorns. And that term was chosen for a reason, to drive home just how improbable it is for a little startup to grow into a billion-dollar giant. For decades, hunting for these unicorns was a game that was only played by a very, very exclusive club.
So you're probably thinking, if the potential rewards are that massive, why isn't everybody trying to do this? Well, there has always been a big red velvet rope around the private market, with a very strict bouncer at the door. And that bouncer is a specific set of government rules. And here's the bouncer's name, accredited investor. See, because these private investments aren't registered with the SEC, they are considered super risky. So the official reason for the rule is to protect regular folks from losing their shirts on a bad bet. But there's a huge debate about this. A lot of people argue that these rules don't really protect people, they just protect the wealthy's access to the very best deals, basically locking everyone else out. So what does it take to get past this bouncer? Well, in the US, you've got to clear a pretty high bar. You either need $1 million net worth, and that's not counting your house, or you need a really high income year after year. These rules basically block out something like 80% of the population. Now, for a long time, that was just the end of the story. But a new door has started to crack open, and it's called the secondary market. We're talking about platforms like Forge and Hive, which have created a kind of marketplace for shares of private companies. It's a potential way in, though, as you'll see, it's still incredibly risky. All right, but let's say you do qualify, or you find a way on one of these secondary platforms. This is where the dream smacks right into a very harsh reality. Investing in private companies isn't just a little harder. It's a completely different sport, a gauntlet of risks that you just don't have to deal with in the public markets. This quote just nails the single biggest risk perfectly. If I change my mind, there's nothing I can do. This is what we call illiquidity. In the public market, you always have a sell button. Here, it just doesn't exist. Your money is locked up, period, until the company has what's called a liquidity event,
like an IPO or getting bought out. That could be in 10 years or it could be never. Now you might be thinking, well, don't those secondary markets solve that? Not really. Say you buy shares from an employee on Forge and then you want to sell them later. You run into something called ROFR, the right of first refusal. It means the company itself or its early investors get the first chance to buy those shares back from you, often at a price they get to set. You have no real freedom to sell to who you want when you want.
The next huge risk is the information gap. Public companies, by law, have to show you their financial records. Private companies? Not so much. This quote is obviously a joke, but it points to a very real problem. You're often making huge decisions based on very limited information. And this is especially true on those secondary markets, because you're buying from some random employee who's leaving, not from the company itself. You're flying almost completely blind. And because of all these risks, the illiquidity, the ROFR, the information gap, the shares on these platforms often trade at what's called an illiquidity discount. You might get them for, say, 30% less than what VCs paid, but believe me, you're getting that discount for a reason.
And what happens if the company just fails? Well, this is where it gets really brutal. There's a strict pecking order for who gets paid back. First in line are the creditors, the banks. After them come the preferred shareholders. These are your big venture capital funds, and their preferred stock gives them special protections. And way at the back of the line, that's the common shareholders. And if you're buying in, especially on a secondary market, that is almost certainly what you're getting. In most bankruptcies, by the time they get to the common shareholders, there is absolutely nothing left. Your investment just evaporates. It goes to zero. So we've seen both sides of this coin now, right? On one side, you have this incredible, almost lottery-like potential to change your life. And on the other, you have the stark, unforgiving reality of a very risky, very opaque world. It all really comes down to a final, very personal calculation. Look, here's the bottom line. That dream ticket for a 10,000x return, it's not free. The price you have to pay is accepting the very high probability that you will lose everything, giving up complete control of your money for who knows how long, and trying to navigate a complex world with almost no safety nets. It is the ultimate high-stakes gamble.
And that brings us right back to you, and the one question only you can answer. Now that you've seen the incredible allure of getting in early, but also the harsh truths about being totally illiquid, the information gaps, the right of first refusal, is this a game you are actually willing to play? Your answer to that really says everything about what kind of investor you are, and just how comfortable you are walking that tightrope between fortune and failure.